This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Sonny Bangia, thanks very much for making it Talk Your Book debut. Really excited to sit down and speak to you today. It's going to be a different Talk Your Book episode today. I thought we'd start with Antipodes Partners and a little bit about your investing philosophy.
Yeah, we're a global equity manager managing approximately $8.5 billion Australian dollars. We look outside of Australia, predominantly across all markets, all industries, and our philosophy is what we characterize as pragmatic value. So we're looking for companies that do offer great value, but obviously we don't want to be dogmatic about that and just look for low price to earnings, price to books. We understand, appreciate industries, businesses go through structural change and disruption, and we don't want to be stuck on the wrong side of that. But we do care about what we pay for a business, as we do believe the value of a business is the sum of all of its future cash flows over time. And that approach allows us to be quite flexible in which industries and businesses we look at. And we construct portfolios of about 45 to 65 stocks as a result. I'm the portfolio manager of the Antipodes Asia Fund.
And in terms of geographic spread, whereabouts in Asia is the predominant amount of your funds invested?
Yeah, from our global fund point of view, it's predominantly in North Asia, China, South Korea, and Taiwan. There's a combination of interesting businesses that are very domestic in nature, but also quite big global businesses such as TSMC and Samsung. And then on the other side, we own Tencent, which is quite a domestically orientated business. And our Asia fund is quite broad across Asia. We are pretty flexible in which parts of Asia we hunt.
So we're going to get into a couple of stock-specific ideas later, but having an Asian investment expert, if you like, in front of us, I was just keen to dig into a broader view of the investment landscape in Asia before we get into those stock-specific ideas. So to start with, the events a couple of weeks ago around Didi and the ruling that came out of China around that seemed like a bit of a step change for Chinese tech companies that are listed in the US. Could you maybe rehash for the viewers that aren't familiar with this story briefly what happened and whether or not you think there are long-lasting implications around Chinese tech companies listing overseas going forward?
Yeah, I think there are a couple of things here. So firstly, we've been undergoing a anti-monopoly sort of regulatory framework for the past 9 months, 6 to 9 months. We can say it kind of started off with Alibaba last year. And Financial was scrutinized for certain reasons. And that's sort of been in the works for a while. Regulation has come out, for example, preventing platforms from picking one platform, in terms of merchants and brands, and that's been in the works for a little while. What has sort of now been sparked by the whole Didi situation is cybersecurity. The regulation on cybersecurity came out last year. There were a few loopholes that Didi has probably taken advantage of. And one of them clearly was that they did not need the Chinese regulators' approval to list on the US stock market. And potentially could mean that, does Didi would Didi be forced to give up some sensitive information about Chinese citizens to a foreign government? These kind of loopholes are now being tightened up. What we've understood, and again, this is speculation and rumor, is that the regulator did ask Didi to delay the IPO, and some of the Chinese-based shareholders also encouraged Didi not to list and kind of go through the cybersecurity review. You'd expect a company like Alibaba and Tencent incredibly sensitive about this. From the get-go, even though one's listed in Hong Kong and one is listed in the US, and have kind of complied with the rules. And Didi kind of was looking for an avenue to go public pretty quickly, One thing we know in the Chinese internet space, it's a very competitive space, and firms are often looking to raise capital in order to compete and move into new industry verticals. And Didi probably took an opportunity to do so, probably at the displeasure of the regulator. So now the regulator is obviously going to make an example out of Didi, like they made an example out of Alibaba last year on the anti-monopoly side. Didi will be the poster child on the cybersecurity side. And I think it opens up a larger question here, Chris, which is, the Chinese government is very sensitive about information going to a foreign government, as foreign governments are sensitive about China. This economic decoupling of the West and China is here to stay. And I think Didi just highlights another example of that we've been, us investors like us have been sort of used to now sort of thinking about over the past few years. I think also to your point about listing in Hong Kong, I think the government will be much more comfortable in Chinese firms listing in Hong Kong. And then obviously the question will become, what is national security, from a security point of view. The government has to make sure the interests are protected. Not every company is going to need to go through those regulatory hurdles. The regulatory hurdles are going to be incredibly high if you list on the NASDAQ, and probably lower if you list on the Hong Kong exchange.
Do you think any of the major Chinese tech firms that are currently listed in the States, could you see them delisting and move to Hong Kong, or you don't think it's been that big an event where that'll take place in the near future?
Yeah, we've already seen movement of, we've seen Alibaba come to Hong Kong, and we've seen more and more Chinese listed, US listed technology companies move back to Hong Kong. I think that trend is still very much intact, and that's going to continue to happen over time. But I think, I do feel that over time, the Chinese government, I don't think, will try to disband the VIE structure in a rush. I don't think that will be very productive or helpful for a lot of companies that are listed in the US. But I think the message is absolutely clear that there's going to be a push towards moving your listing to Hong Kong, and then eventually moving your listing to onshore China onto the Shanghai Composite. But I think that's much more down the road.
The other thing I wanted to touch on was the Chinese bond market. We've seen 10-year yields on Chinese government bonds at just under 3%, which is obviously a lot higher than we're seeing in the US. And it sounds like a number of institutions are moving their bond investments that way. Do you think that's going to be a growing trend, or do you think there'll be, considering the Cold War that the US and China are currently experiencing, do you think there's going to be a limited number of institutional grade investors that want to take up that rate differential?
Yeah, it's interesting, Chris. It's definitely a political Cold War. From an economic and trade point of view, I'll have to say and admit that there is no Cold War. The US economy is as dependent on China as China is on the US. The pandemic, US imports from China skyrocketed, much to Mr. Trump's displeasure. Economically, we're still very, very linked. Now, I do believe that the decoupling will happen. The Chinese economy will become more insular. There's an enormous rise of wealthy Chinese households in China. So we're going from at 25 million households in China that earn above $80,000 per annum to 100 million households by the end of this decade. So that household in itself, that 100 million households, will represent a $9 trillion economy. And so the economic decoupling is going to happen. The move in the bond market, I think, for the moment, global investors, US is still the key market. It's the most deepest and liquid market in the world. China is quickly coming up the ranks in terms of rivaling that, and obviously potentially displacing a lot of European sovereign bond markets. There's a couple of reasons for that. There's very little government interference in the Chinese bond market versus in the Japanese or European, and to some extent into the US bond market, where private investors are crowded out from those individual bond markets, and it's sort of forcing global bond investors to look for other alternatives, a deep, liquid, stable bond market with a stable exchange rate. and the Chinese bond market is proving to be a very suitable alternative. The other thing is that China is experimenting with their digital currency. It will be interesting to see whether they push the digital currency down the trade avenue, as in, do they, if you're a big trading partner with China, let's say South America, and you want to settle that in yuan, potentially you can do it through the digital yuan avenue. Now, as you start trading more and more with China, you start holding more and more Chinese yuan in your reserves. You naturally start buying more Chinese assets, particularly government bonds. I think this is going to inevitably happen because China is an enormous trading partner with the majority of the world. So look, I think there is obviously a political Cold War. Economically, do think we will keep decoupling, which means we'll try to find domestic avenues of growth. But capital markets still feel very much intertwined. It feels at the moment quite hard to break away from that linkage without causing enormous economic disruption.
And what are the major trends in China that you're looking at the minute that are most interesting to you?
Look, I think one of the most interesting trends is definitely the rise of the premium consumer. We talk a lot about the middle income of Asia and emerging markets, and that's very true. But I think China has gone past that. And China is effectively moving into what we call the higher middle income economy class, which is something we think about with South Korea and Taiwan. So if you look at the development of China over the past 20 years, it's following a very similar path to South Korea. Now, what happens is around that 10,000, 12,000 US dollars per income, a lot of emerging markets get stuck there, and they struggle to go from 10, 12,000 to 20. And it looks like China is making the leap. How are they doing that? Embracing technology, embracing infrastructure investment, productive economy. And as a result, the growth from 10, 12 to 20 is now being driven by this very wealthier cohort of people, which are moving into this premium consumption. And these people will buy luxury goods, and we think a lot about that from an LVMH point of view or a Kering point of view, but we don't appreciate that this is going to drive a lot of purchases of high-end luxury cars in China, not just Teslas, but potentially locally domestic brands. It's going to create an enormous boom in outbound travel. So approximately 100 million Chinese leave China each year to travel. Half of them are still going to Macau and Hong Kong and Taiwan, and 50 are going to other parts of the world. So we think that will be a big booming part of the economy. And then the services side. Private banking and financial planning and all these industries are really early on in their growth in China. As people get wealthier, they look to buy insurance, they look to invest their assets, and the growth in the services economy will take off. I think this is one of the most exciting trends in China. And as you become wealthier as a country, you think about your environment, you think about quality of life. And that's the other really interesting thing that's happening in China, is that the Chinese government is pushing an incredibly powerful green agenda. China wants to push aggressively down the renewable path. And so the other big trend occurring in China, and we'll talk about it more today, is the growth of the renewable sector, which will be a very strong structural growth trend over the coming years.
And so that's linked with electric vehicles too, isn't it? Chinese government has put mandates on electric vehicles and the percentage they want to, vehicles to be purchased that are electric, which is going to have huge flow-on implications to baseload power and that coming from renewable sources. Maybe talk to me, start with the EV thematic. Just how big is it, and what are the mandates that the government are putting around EV purchases going forward?
Yeah. Now, when it comes to things in China, you always have to think about it's just a big market for anything. And so the first point, it's a big car market. You've got 24 million cars being sold in China each year. So it is a large market, and that's growing as the penetration of cars continues to grow in the population. And the government has mandated that 20% of all car sales to be electric vehicles by 2025. So, based off that alone, you're talking about, let's call it 5 to 6 million cars being electric. So in itself, the Chinese EV sales market will be one of the biggest car markets in the world. What has happened in the background as the government has put these targets forward? It has also fostered enormous innovation and pushed the whole supply chain of electric vehicles to be built out in China. Basically, the only thing China needs to do is source the raw materials from, countries around the world that are exporters of commodities, but the chemicals and the production, capital equipment, and final EV is made in China. And so over time, there's been enormous investment in the back end of EVs. So you've come to a point where the cost of a premium EV, like a high-end luxury EV, is below an ICE vehicle. And so what we're seeing is that the high-end consumer is happily buying electric vehicles rather than buying high-end ICE vehicles. That's already happening in China. Now, the next part of that will be when that moves to the mass market. There are some mass market brands that are at the same price point. And as battery costs come down over time, that will probably move more into the favor of electric vehicles and then push more of the consumers towards EVs. And so we think that target of 20% by 2025 probably will get achieved in 2023. We can kind of look at today that 10 to about 15% of all car sales are EVs in China. So it's already going on the right path. And then again, on the back end, China's government is investing in the charging infrastructure, charging stations with on highways, in residential areas, so that people can sort of continue on that trend. So it is quite interesting. We kind of think China's leading the world in terms of EV adoption. Europe's probably a close second, and then we'd say the US would probably come faster over the next couple of years as potentially more subsidies come out of the US as well.
And there's not a huge net gain to EVs if the baseload power charging those EVs is coming from coal. They're also moving heavily into renewables, uranium as well, but renewables to increase their baseload power and the cleanness of that. Which renewables do you think are likely to win most out of that transition?
Yeah, absolutely. Look, what's really interesting and two big points here is the Chinese power market is still a growing market. It grows each year as more people are consuming goods, moving into the middle class and even into that premium class. So the growth of the Chinese power market per annum is basically it's like a Texas each year. China's is incrementally consuming a Texas or Netherlands plus Britain in terms of size. So there's more growth. And what's really also interesting is over the past decade, the cost of renewables, let's say solar, have been falling very predictably at about 10-15% per annum as improvements in technology scale have been happening. Now, solar has not been competitive to coal over the past decade. And so you've had a boom bust cycle over time, particularly when the government gives subsidies, then the government takes subsidies. You've had this stop-start industry. In 2020, just through that falling cost of solar through time, the costs have now hit and have now gone below the cost of thermal coal. So there's been a huge shift in China as a result, huge shift in the capital markets view of all of this now. The Chinese government wants to push for renewables, primarily solar, over the coming decade, because the cost of implementing a new solar power plant is cheaper than doing coal. Also, China doesn't have to then rely on foreign countries for coal imports. The sun is free. But also what it does is if you can start to implement more of your baseload power through renewables, and that source of energy is free, it can actually unlock enormous productivity opportunities for your economy over the coming decade. So we think today China's got about 200 gigawatts of solar installations, 220 gigawatts, which has happened pretty much through that boom bust. Now that we've kind of gone into this period where the unit economics are more favorable for solar, we think that could probably increase by 4 or 5x over the coming decade. So you've got a solar industry that can grow at about a 17% CAGR over the coming decade. So it's transforming from a cyclical boom bust into a structural growth industry. And what's happened in the background is China's built out some of the largest solar wafer makers in the world as well. So it's actually in a good spot to build out its own industry, given it's got all the localized manufacturing for solar.
And what company are you investing in to play the solar thematic?
So we quite like a company called Longi Green Energy. They've been this company was formed by a husband and wife that were chemical engineers. At university, post-university, they sort of formed this company and had gone down this path to go into the green solar space. And over time, they've sort of been part of that boom bust solar industry talked about, but they've consistently just been doing an incredible amount of R&D over time. And what they've done is effectively been able to just lower the cost of solar wafers over time to become the lowest cost producer, not just in China, but globally. And over the past sort of 5-6 years, they've been able to take enormous market share to the point where they're about 60% of the Chinese solar market in terms of solar modules and wafers, and about 30 to 40% globally. So it is an enormously large company with huge scale. It's a $60 billion company. We think this is in the box seat as the lowest cost producer of solar modules and wafers to really ride the boom of the solar build out in China, as we talked about, with the cost of solar being below thermal coal. But that cost of solar being below thermal coal is not just a Chinese phenomenon, it's also a Southeast Asian phenomenon. So think Vietnam, think India, Indonesia. And we just think over the next year, a few years, a lot of these countries will also embark on big solar booms, and Longi is well positioned to export into those markets. So it's a very Asian Chinese domestic play to capture the big boom that will happen in solar in Asia over the coming decade.
And what sort of earnings multiple is it trade on?
Yeah, so this is a business trading on about 25 times next year's earnings. And we think these earnings are very durable and sustainable going forward. It does about a 25% return on capital, and so we think on those sort of returns, growing at high teens, we think they'll actually grow in the low 20s. They'll still take more market share given their cost advantage. We think this business has all the hallmarks for being able to compound those earnings growth on high returns on capital. So we do think we're buying quite an interesting company that's got this long tail of growth.
And you're not just focused on China, you're also interested in Southeast Asia and the investment landscape there. Maybe talk me through an outline of some of the things you're looking at in Southeast Asia from a broad macro view before we get into your stock-specific idea there.
Yeah, and look, emerging markets have really evolved over the past 10 to 15 years. In some instances, they're behind in some trends, and in some other instances, they're ahead. And what we've learned with China, they're ahead in e-commerce, fintech, potentially now in solar, renewables, EVs. But there is this huge opportunity in the rest of the emerging markets, such as Southeast Asia, where you've got a $1 trillion retail sales market, and only 8% of it has moved online. A similar phenomenon in Latin America, we've got about a $1 trillion retail sales market, and again 10% has only moved online. Now in comparison, we think about the US, which is about 20-25%, and China, which is more 30-35%. So this is really exciting for us, Southeast Asia, where you've got 800 million people that are now consuming things online that most Western markets and China take more for granted.
And what company are you investing in to express that investment thematic?
So we like this company called Sea Limited. Their origins are from Singapore. They've been focused on gaming and game publishing in the Southeast Asian region. They have a partnership with Tencent, which allows them, which gets them access to some of Tencent's IP in gaming, and they've kind of then looked to sort of benefit from the rise of mobile gaming in these Southeast Asian economies. Now, a lot of people in Southeast Asia are basically going straight to handset. They're sort of bypassing the migration to desktop or laptop. And so everything is done on your handset, and gaming being one of them. But then obviously it translates to more other things as well, such as payments, e-commerce, and all these other opportunities, on-demand logistics. So C's kind of thought about this opportunity a few years ago and started investing in e-commerce in Southeast Asia, first in Singapore, Taiwan, but then moving broadly across Indonesia, Malaysia, Vietnam, Thailand, and has now cemented itself as the clear number one in the position. Now they had to go through a bit of a battle with Lazada, which was the Alibaba's Southeast Asian e-commerce. But I think what's really interesting is when you're operating in these markets, you need to have localized expertise. C has sort of done a great job in terms of understanding the local nuances market to market. I guess Lazada was sort of piggybacking of Alibaba, and then using a lot of the Chinese sort of understanding in Southeast Asia, which actually didn't end up working out for Lazada. And now we're in a situation where C is dominating e-commerce, but now moving into fintech. There's approximately 300 to 350 million unbanked people in Southeast Asia. And so the banking experience for a lot of these people is quite poor, either through lack of access, lack of branch access, lack of financial inclusion. And so fintech is, buy now, pay later, which is a concept we've sort of very familiar with in Australia now through Afterpay, is just something that happens in Southeast Asia because it is very early, and it's a great way to start including people into the financial economy. Now, what gives C a huge competitive advantage is that they've got the dominant e-commerce platform, and then they use their fintech or payments infrastructure to facilitate that e-commerce trend. And so people get educated on fintech through the C e-commerce platform, and then can take that into their offline world when they want to go out and buy something at a shop or buy at a store. They can take, their basically e-wallet to the offline world as well. And so we think the fintech opportunity in C is as big as the e-commerce opportunity that they're currently tackling as well.
I'm interested in that unbanked phenomena, which is quite common in other parts of the world. There's a small number of people in Australia who are obviously unbanked or underbanked. But as banking gets disrupted, does that go from being a country's weakness to potentially becoming a strength, as you don't have a legacy banking system that's got to go through these costly changes almost not overnight, but in a small period of time, a country can go from being a long way behind to actually further in front because they can jump straight on a new technology that fintech is opening up that countries like Australia may be slower to adopt?
Yeah, it's an interesting question, Chris. I think, we should think about China in this context because you can sort of argue a similar dynamic happened, that the Chinese banking system, very SOE, state-owned enterprise driven, was always focusing on serving corporates. And so retail Chinese consumers kind of got left out. And then Alipay and Tenpay came along and sort of filled the gap that the banking system in China sort of missed out on and wasn't focused on. Now, what has it done? If you think about, let's just talk about Alipay because they're the largest payment network in China. They can process transactions 10x the quantity that Visa can process at the moment, right? At a tenth of the cost. So what it has done, it is actually really lowered the cost. It's made it incredibly frictionless. It's reduced costs in the system, which is effectively passed on to the end consumer, improved productivity of the entire system. And you're now at a point where you've got a huge advantage. And your consumer is very digitally savvy. They become used to your app not just being a payment app, but actually becoming a kind of a financial supermarket. It's the place I go to do all my financial needs, whether it comes banking, insurance, buying and selling stocks. It's all sitting in one little neatly tied up app. And now Sea kind of has seen this in China. And obviously, they've got a very strong partnership with Tencent, as Tencent's a shareholder. They kind of think about the same opportunity emerging in Southeast Asia, and that they're in a great position to be the super app, the super financial app for the region. And again, I think from a government point of view, it's really positive. To include people who are sort of cut out from the financial economy. It brings them into the system. It also does incredible things for productivity and long-term economic growth. So I think the governments of these regions are quite positive in encouraging people to use digital wallets to kind of bring themselves into the financial economy.
And what sort of top-line revenue growth can you see Sea Limited having over the next few years?
Yeah, look, I think for the moment, e-commerce itself, we think will grow in the 20s. We're talking about 10% penetration going up to maybe 25 over the coming 5 to 6 years. The gaming business is doing quite well, as they've seemed to have found a few hit games, and then fintech is just an ongoing big opportunity. We know there's a lot of market cap in banks in the region. So, for example, the average Indonesian bank will earn about $30 to $40 US dollars per customer. So if Sea can even take half of that and earn $15, $20 per customer, we think that's enormous upside from currently zero. As they're moving into the fintech arena, and then the fintech profits are more lucrative in Singapore and Taiwan, where it's closer to like $200-$300 per customer. So it's I think a story where we can see probably low 20s revenue growth over the coming years.
And it must be a huge addressable market. How long do you think it could see those top line growth numbers before it start to peter off?
Yeah, it's interesting. From our observations in China, it took e-commerce to get to about 35%. It took 15 years. Now, of course, there was elements of building the infrastructure. There were elements of just customer awareness. Those things are going to be a lot faster now. People are much more inclined to buy things online. The other thing is that the shopping experience in some of these Southeast Asian countries is really poor. So over typically crowded malls and very busy to get into the malls, and a lot of traffic on the domestic road. So the experience online will probably speed up that. And secondly, Sea is investing heavily in logistics to get goods delivered to individuals next day. And that speed up is probably going to mean, instead of taking 15 years, probably takes 5 to 7 years. Now, what we think is that whilst they're doing that in e-commerce, the big opportunity again is the building a super app like we see in China. We haven't really seen a super app in the Western markets, but I think in Asian countries there's more of there's more not just awareness but also willingness to use a super app to sort of manage your life affairs. And that's
WeChat when you refer to the super app in China. Is that?
Yeah, that's WeChat. That's right. Where you basically run your life inside of WeChat. Now WeChat's so dominant and powerful that Teams meetings or Zoom meetings happen within WeChat. Corporates have their entire network sitting in WeChat, communicating to their customers, to their employees. So these are the kind of opportunities. If you really get your super app right, you can bring the entire ecosystem inside that app, and that just keeps opening up more and more opportunities. And I think that's what's really exciting about Sea, that we're just really early in that growth of that opportunity.
That's great. Well, there's a couple of really interesting companies to look at. It's days like these, Sonny, when I wish I was invested in more high quality companies instead of the crap that's in my portfolio. But I look forward to following them from the sidelines and love to have you back on for a chat sometime in the future.
Thank you for the opportunity. Thanks very much.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.